Hello, Nicole. How are you today?
Oh, fabulous. I love the fall.
I love the fall too. And welcome everyone to our October monthly mortgage and market update. Nicole, as always, we have so much to talk about. So I just want to dive into it because we were just talking about how I was reading a very interesting yet sad quote from the senior economist and director of forecasting at the National Association of Realtors. And she is saying, with the rising interest rates, which is what we're going to talk about in a little bit, stubbornly high inflation and a battered stock market, the financial environment for the buyers out there, the buyers trying to get into these homes, is just getting worse and worse. Now, with the interest rates, on average, she says this week near to 7%. It's the highest that they've been since April of 2002, according to her. She says people need to earn $40,000 more to afford a median priced home compared to this time last year. $40,000. That is some people's yearly salary. And couple that, like we just talked about, with inflation, prices of everything are going up. This market is not, it's not a trick-or-treating market. It's just a tricky market to deal with right now. And I want to transition to you because you have a program, an option as from the mortgage side that sellers can offer to buyers to helpfully get them under contract on their house. And then for the sellers to obviously then close and sell their house, which is what every seller's goal is. So it's called a 3-2-1 buy down. So I want to transition to you. Tell me what that is. Give it to me in layman's terms.
So a 3-2-1 buy down is going to help both the seller and the buyer, especially in a market like this, because as a seller, you're trying to have your listing stand out from others, especially if you have competitively priced homes, maybe in the same neighborhood or the same block. So to offer a 3-2-1 or a 2-1 buy down, what that means, a seller buy down is taking a seller credit. So if I'm selling you a house for $750,000, I'm also going to offer you an $18,000 seller credit to buy down your rate. And most people, when they immediately think buy down my rate, that means, okay, I'm going to buy it down once. I'm just going to buy it to whatever the rate is today, 7% down to 6.5%, and I'm going to use that money to buy down my rate. You can go further with a buy down strategy. I can take that same amount of money and I can spread it out over 2 to 3 years, making up a difference in your monthly payment. So what a 3-2-1 buy down is, and I'll just stick with that one. A 3-2-1 buy down takes a credit from the seller, puts it in an escrow account, and uses a little bit of that money every single month so that it effectively buys down your interest rate, 3% the first year, 2% the second year, and 1% the third year. Then for the next 27 years, it's the interest rate that you originally locked in at. The thing is we're all expecting interest rates to go down. We don't know exactly to what level, but we do know that once inflation is tamed, we are going to see a reduction in the interest rate, and the opportunity will present allowing you to refinance. When you refinance, any money that's left over in that escrow account, meaning maybe it's just a year from now or a year and a half from now, any money that's still in that escrow account will immediately go towards your loan and pay down the principal. So you don't lose a thing by doing a buy down.
Wow, that's really interesting. So I was wondering what happens if somebody does refinance after 1, 2, 3 years, if the interest rate does go down to a more suitable interest rate for their liking, what does happen to that money? So that's really good to know. And it's really key to have these strategies in place with the plethora of inventory that we're seeing. You know, you and I do these videos every month. And I remember earlier this year, just this year in 2022, but earlier, like the first quarter, I would always pull the same number, which would be how many homes are on the market in the city of Denver proper, under 1 million single family homes. And back in the first quarter of the year, it was about 100, 111, 132. And now, and now in the past 3 months, every time I pull this number, it's close to 800. So we're not in a balanced market yet. We're not close to it. But at the same time, buyers have so much more inventory to choose from, which is another aspect the sellers need to understand. It's not just their house these buyers can look at. It's all of the houses that are on the market in that price point. So strategies like this are so good. And even coupled with the fact if the sellers do want to do a price reduction. I mean, I get it. It's kind of a double whammy doing the price reduction plus offering that credit of maybe $15,000, $20,000 for the interest rate buy down. But if it gets your home sold, it gets your home sold. So
it is a big deal. Just really quickly, it is
Yeah.
a really big deal for a buyer. So in that example that I just gave you, if you could buy down the rate from 7 to 6.5 versus going 3% lower from 7 to 4 the first year, 7 to 5 the second year, that payment difference can absolutely make that buyer, knowing that they have the opportunity to refinance, but still having to qualify. So you're still within affordability, but it gives that buyer the advantage to say, this is a home that I can grow into. This is a home that over the next 2 to 3 years that we can continue to work on our budget. So it opens up the available buyers that one seller they had if they didn't do that 3-2-1 buy down.
Absolutely. Not exactly just in a price point, but like you said, if this also can be offered, then it opens up the buyer pool a little bit more for them. So with that being said, interest rates are expected to go up this week or next week.
So the Fed rate is going up. They're coming out on November 2nd. So we will see the Fed rate going up. A lot of our 30-year fixed is based more on the expectations and the fear around the market. So we are seeing a continued volatility. So are they done going up? I don't know. I really wish I could say, yes, they're done. They're only going to come down from here. But we will still continue to see volatility through the end of the year. I know going into next month when we meet, we'll talk a lot about the consumer price index and inflation compared to last year, because that's expected to start to take a dip, and that could really help our interest rates as we end this year.
And lastly, Nicole, I was talking to a seller today who's been on the market for a month now, and he had a interesting question. And I don't know if you can answer this, but he said, why does the government keep raising the interest rates? Why are they doing this? They know the consumer is already hit with the inflation, with the battered stock market. Like, why? It's like a triple whammy now. Like, why do you think the government keeps raising the interest rates on us? Is it just because they were so low during COVID?
It feels like that, doesn't it? It feels like everybody's against me. Why are you hurting me? But the Fed did come out last month saying that we need pain. We need consumers to stop spending. We need people to stay home for a couple of months because we have to allow supply to come back online. That balance between demand and supply is where you see this inflated inflation that we've been feeling. These inflated prices start settling down as you start to get supply and demand back in balance. Now we're feeling this in the real estate market. We are the first ones to feel any kind of rise in interest rates. Other markets aren't. I mean, how many of your friends are in Europe right now? How many of your friends are going out to eat? Have you been to a steak restaurant lately? It's full. The restaurants are still full.
I have 2 of my close girlfriends in Europe right now. So yeah, I hear you.
People are still spending, even though we know that the housing market is feeling it. It felt it first. We know the rest of the economy is still working and jobs are still secure. People are still spending. They are trying to effectively slow down all consumer spending, not just in the housing market. So rising the credit card interest rates, rising saving interest rates. So I'll put more money in savings. I'll spend less on my credit cards. I'll decide to stay home instead of going to Europe. That's what the Fed needs to see in order to calm down the increased prices of everything.
Well, I hope the Fed can calm down sooner than later to help out these buyers. So
yes.
Nicole, thank you again for meeting with me. And I look forward to talking to you next month. Well, again, like you said, we'll have so much to talk about heading into the holiday season. And for now, happy Halloween, because it's in a couple days. I hope you get lots of treats and no tricks, and we'll see you next month.
Bye-bye.